So accounting profit primarily is accrual basis. I mean, for the companies we're looking at, it's accrual basis. For tax income, it's actually more of a mix. So you do see some accruals in there, certainly depreciation gets done in there, but there is a lot more cash basis to what happens. What else is important? Some revenues and expenses are excluded for tax. I'm pretty sure parking fines you can't claim as a tax deduction.
No.
I'm pretty sure you can't claim parking fines as a tax deduction. Been a while since I got my last parking fine, and they're a pain in the proverbial when you get them. But that would be something which would affect the profitability of the business, but it's not something you can actually claim the deduction. You can claim a deduction for. You may see situations where just governments try to promote certain industries or promote certain activities. So they'll say, look, you get extra deductions on R&D. You get extra deductions for basing movies here. So if you're making a movie, then they'll give you sort of tax breaks on doing those sort of things. They're trying to promote certain activities, trying to stimulate the economy. So the way tax and profit and accounting profit work basically is not necessarily the same. So as we talk about long service leave is expenses accrued. Revenue received in advance. Now, initially as a liability, then recognized as revenue is earned, typically taxed on receipt. Well, don't know if that's wholly true. I mean, some revenue is taxed on receipt. Interest revenue is generally, and interest expenses and revenues are generally done on when the cash actually moves. So other revenues may actually be done on just when the sale actually happens. So it's not 100% true, that statement. But it does get at some of the aspects of that. Page 630 gives you some more examples of where certain things are different. And we won't deviate too much from those examples. If we do, we will provide you guidance as to how the tax works for it if you get a question like that. So I mean, there are certain ones which we expect you to know. Outside of those, we will give you guidance as to how to do it. That's a busy slide. And that is pretty much, this bit is a bit sort of mentioning things like long service leave, warranty expenses, doubtful debts. You should have a sense of how these things work. And those are pretty much what you see in that table. Outside of that, we will provide you guidance. Bless you. Now getting into this, the tax payable method, the tax effect method actually incorporates the tax payable method in there as well. The tax payable method is not what we're looking at. So this isn't a choice situation. This isn't they could do it this way or they could do it that way. The companies that we're dealing with and what AASB 112 requires is it use the tax effect method. But before we get to that, we need to have a look at what tax payable is, because this actually sits inside the tax effect method. So tax payable is basically figure out how much your taxable income is. So those of you who have done taxation law have some idea of what's going on there. Figure that all out. Figure out what your taxable income is. Figure out what your tax payable is. Now that's currently 30%. That may change. So if that effect of the budget goes through, that's going to come down to 28.5%, which I'm sure the textbooks won't change any in the near future, and who knows when that 28.5% comes in. But you can imagine that's going to be a lot fiddly to have to calculate all these tax effects when you're using 28.5%, then 30%. So it's not a reason. I mean, there are lots of reasons not to fail this course. I don't think that's necessarily one of them, to avoid the tax change. But I don't think there's anyone here that actually wants to fail the course, so that's a good thing. That is what you pick up as the current tax payable. So that is the money that you owe the government. And you pick that up as an expense. When you pay it, when you're a good corporate citizen that you are, you get rid of the payable and cash goes out of the business. And that's it. That is the limit of the tax payable method. The tax effects method, which is what we're interested in, goes a step beyond that. So the tax effect method shows the tax expense is the tax payable to the ATO, then adjusting that tax payable. So we're not adjusting the tax payable, but we're adjusting the amount that we picked up for the tax payable by the effects of DTAs and DTLs. So if we have DTAs, we're going to see, and those are increasing, we're going to debit DTA. If we see DTLs increasing, we're going to credit DTL, and there may well be some sort of overall effect on your tax expense. And that's one of the reasons, if not the reason, why you see the tax expense is not equal to the money that companies pay the government. This bit is incredibly important. A DTL is not showing that you owe the government at the moment. It is not a situation where it's showing you have a bill that you have to pay the government and you're going to pay them in 12 months' time or 2 years' time. It's not saying you currently owe anyone anything. If this business suddenly collapsed and you had DTL sitting there, no one's going to come knocking on the door of whoever's administering it and trying to sort of divvy that up as part of the creditors. That DTL is something different entirely, and that's what we're going to have a look at. Same with DTAs. The DTAs are not saying the government owes you money, and you could go knocking on their door and say, hey, I want some. It's not picking up that at all. It's picking up the tax effect of accounting effects, sort of a second order thing, and we'll get to that. And what causes this, and we've talked about these timing differences a little bit already, but what causes this is timing differences between how tax works and how accounting works. So you may have equipment which is being depreciated out over 8 years for accounting purposes, but for tax purposes it'll be depreciated out over 4 in this particular example. That means you're going to see a much higher depreciation expense for tax, so the tax deduction is going to be quite a lot higher than the accounting effect. That's going to be much higher for the first 4 years, but then after 4 years there are no more tax deductions because you've already got the full amount of deduction for it, but you're still getting accounting expenses. And by the end of it all, and we'll see how these numbers work out, by the end of it all everything works out to 0. So you actually will start at the same point and you'll end at the same point, but there's just a difference during the life of the asset. So the things we need to have a look at, so this is a balance sheet approach to all of this. So what we're looking at is picking up the accounting numbers for those assets and liabilities. At this point in time, you guys are well aware of how to do all of that. So the accounting numbers will either be given to you or you have to figure them out, but that is something you guys are well aware of. The tax base is something we're not too sure of at this point and we haven't calculated out, but what we're basically going to do is compare that accounting number with this tax base, take whatever the difference is, and that difference is a temporary difference. Then we need to figure out the DTA and DTL of that, and that DTA or DTL is that temporary difference multiplied by the tax rate. We don't know whether it's a DTA or a DTL, and we will look at that. But if you work through it, given that we know the carrying amounts, or we're going to work on the basis that you guys are aware of the carrying amounts, the difference is just working out using the subtract button on your calculator, so that's not a difficult thing to do. The tax rate will be provided, so to work out the DTA or DTL is just literally using the multiplication button by 30%. So the thing we need to work out is what is the tax base and whether or not that temporary difference is a DTA or DTL, or is going to give rise to a DTA or DTL. So the first thing is, what is the tax base? And the tax base of an item is the amount attributed to the asset or liability for tax purposes. So in essence, it's like you were running a separate balance sheet, but this balance sheet is created using tax rules instead of accounting rules. So if you're depreciating an asset over 8 years for accounting rules, that would be based on your estimation of its useful life, how you think the asset's going to be used, so on and so on and so on. You would then almost have a second book looking at, well, we have this asset and we get under the tax schedules, we're going to use 4 years as its useful life. That's what you do it over, and that's the numbers that you base it on. That difference is the temporary difference. So we need to look at how we figure this out for assets and for liabilities. So for an asset, and I will preface all of this by saying there is the official definitions that you see here. The tax base of an asset is the amount, blah, 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 and when we look at liabilities, there is the official definition. They're useful to have, and look, if you've got the standards with you in the exam, which you will have, you're going to have these with you. So it's not like you have to remember them. The important thing is twofold. One is to try to get a sense of what these actually mean in reality. The second thing is just after paragraph 7 for assets and just after the paragraph for liabilities, they actually give you 5 examples of real asset accounts and then real liability accounts and what the carrying amount is and what the tax base would be. So you actually have a lot of examples sitting there in the exam with you. So that will help jog memories if you need it. So the tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. If those economic benefits will not be taxable, the tax base of the asset is equal to its carrying amount. So let's start off with looking at machinery, and then we'll expand that example out just to make sure, hopefully get everyone on the same page. So we have machinery and it costs us $200,000. At this point in time, actually even before this point in time, let's just look at that first bit. That machinery costs us $200,000. We're working on the assumption that that machinery, all of that cost, we will be able to get a deduction on. So when you see that machinery, yes, you have paid $200,000 and you have a very, very expensive phone, which will just double as a piece of machinery. This thing is $200,000 you spend on, but it also reflects that you will be able to get deductions of $200,000 over the life of the asset. Now that all happens quite quickly because of the way that the tax depreciation rates may use, but we will get $200,000 worth of deductions. That's the thing to bear in mind. So at the very starting point, the tax base of that asset is $200,000 because it reflects the amount that will be deductible for tax purposes, which is the $200,000. After however many years that's happened, we don't know, but you've had tax deductions, so the tax depreciation, which is the amount of deductions you've already had, that's equal to $20,000. That means you've got $180,000 left of tax deductions. And that is why the tax base is $180,000. Actually, we don't really need to do anything with that. $10,000 in accounts receivable. I just realized I made a little bit of a typo there, so it's talking about included in taxable income. So $10,000 in accounts receivable. In that case, and the revenue in this particular case has already been included in taxable income. So even though you haven't received the cash yet, that sale, or if that was just one sale, that sale has already been included in revenue. Sorry, in taxable income. So you've already been taxed on it. The tax base is 10 grand because the benefits that you're going to get, the benefit is receiving that cash, you're not going to get taxed at that point. If those economic benefits will not be taxable, the tax base of the asset is equal to its carrying amount. If those benefits are taxable, then it's not going to be equal to its carrying amount. So for example, interest receivable, and in interest receivable, you get taxed based on when you get the cash coming in. The tax base on that is going to be 0. And so it works slightly differently. And again, those examples, those two, actually I think nearly all of those examples, both of those examples and the last one I just talked about are in the standards. So you can have a look at them in an exam. Okay. Okay, so we started with $200,000. After 1 year, let's just say this has been depreciated out over 20 years. This one has been depreciated out over 10. That'll go down 200 to 190. In time 2, I'm not going to do all 20 years. So on. What you can see happening. So that would continue down, and you just keep following that down. At some point, this is going to hit 0, So 120 and so on until you hit 0. This will still have $100,000 in it. And then if you keep going and you extrapolate it all the way down, you'd actually end up with 0 and 0. So that's at time 20. At this point, these two are exactly the same. We're starting to see differences. There's a $10,000 difference, there's a $20,000, there's a $30,000. And that difference will keep growing until this is being completely depreciated out and we've got all the deductions for it. And then it will start coming back around and we'll end up with 0.